All right. Welcome to our own version of Markets in Chaos. Todd Gordon, Kyle Wasson, Inside Edge Capital. Happy Monday. How are you, man?
Happy Monday. Doing good. How are you doing?
I'm good. A little tired. Let me turn this video down here, Kyle. So yeah, throw headphones on if you don't mind. A little
Sure.
bit of feedback, but yeah, all's well. So I was we're down at the beach at my wife's sister's place, and I had a feeling it was going to be busy. So woke up at about 4 a.m. and saw where the futures were overnight and where the VIX was, which we'll talk about. And woke up, I got in the car, jumped in the ocean at about 4:30 this morning. It was 59 degrees the water. Just to wake up, a couple Celsius, a couple coffees. I drove 4 hours and I've been on the market all day, talking to Kyle and the team and just watching the sell-off. And I wanted to just get this together quickly for you. This is not going to be a professional presentation like we normally do, but a lot of volatility, a lot of questions with our investors, and just wanted to talk to it a little bit. And we're going to be here. You should be able to
Yeah.
write questions in there on the YouTube window. So we'll just take you through what we see, give you our input, update you what's going on here at Inside Edge Capital, and probably gets you out here in about 25 minutes if that's okay. Kyle, what do you think? Opening comments?
Yeah. Yeah. Sometimes our vacations get cut short by the market. It just happens.
Yeah, that's okay. Yep,
Okay. It's
I had
part
a
of the
feeling.
job.
I had a feeling. I kind of let people know. I was like, I may be back Monday, the way things were going. So it wasn't that much of a surprise, but it was all good. Did get to go to a Yankee game. Brought my twins, and we got there early. We did Monument Park and the Yankee Museum, and we had a great day. So it was all good. But
Nice.
yeah. So all's well. So again, anything before we jump in, Kyle? Anything from your point of view? Again, we did open this up to the public, but we're obviously speaking to our investors directly as well. So anything top of mind, or just dive in?
Yeah. Let's go ahead.
Okay. Here we go. So let me just get some comments,
Grab
questions.
some headphones.
Yeah. Okay, beautiful. All right. So here we go. Let's. It's going to be kind of all over the place, as I said. We didn't have. I didn't have proper time to put a full presentation together, but I have some slides and be showing you some live charts. Talk about some concepts, and again, any comments or questions, please let us know. So I know that is going to be challenging to see. In fact, you don't even need to see the bottom part. Right? I'm just going to leave it over. But from where I sit, there's eight factors driving the market volatility in here, in no particular order, not ranked by significance. Buffett, it just came out that Warren Buffett cut half of his Apple stake, which probably couldn't have come at a worse time. Nvidia, which has been the big leader, obviously in the semiconductor space, has delays on their production of their latest Blackwell chip. Could be about 3-month delays, which didn't really need that right now. We have geopolitics. From everything we gather, a strike from Iran to Israel, I guess, is imminent. It could come at any time. So we have escalating tensions in the Middle East. As a side note, I would say crude oil is not moving. We're pretty well entrenched in a consolidation pattern right around $73, $74 a barrel. So there's no war premium, escalated tension premium in crude, which is good. I think domestic politics is also leading to some uncertainty. There's a lot of volatility in the polls between the two leading candidates, and I think there's some I'd say displeasure of the way this political season is going, and we're only 93 or 92 days away from the election. So I think that's adding volatility. Seasonality is real. August and September are traditionally a weak stock market month and a high volatility month. We're going to get into the VIX, the volatility index. It reached ridiculous levels this morning. There's a lot of concern. We're putting our intern to work. It's too bad he's not here right now, but we're putting him to work on looking inside of how much, particularly the Mag 7 companies, are spending on AI infrastructure and how it's impacting their margins, free cash flow. We're comparing it against Apple, which interesting that Apple is spending about 10 billion, where the other significant mega cap growth are spending 30, 40, 50 billion in capex, capital expenditures to invest in the AI infrastructure. And we found that Apple puts a lot of the money into R&D, internal research and development, but they're not spending on the AI, hardware, servers out of, and chips, GPUs out of Nvidia or Dell or SMCI. They tend to rely on their partners to use their spend in their artificial intelligence. So Apple's been pretty good with its capital, not spending too much, and I think Apple was showing some pretty good relative strength. But then we got hit over the head with Buffett cutting half of his Apple stake, which that's a long discussion where Buffett's a value investor, and he was in Apple for a long period of time. It's become much more of a growth stock, which means the valuation is very heavy. So, it makes sense. He took only half the position off. It's not a referendum on the company. It's a valuation call. And yeah, it's expensive, but as Apple is embarking in AI, it could go from 33, 34 times earnings to 40, 45 times earnings, get more expensive and act like a growth stock. So, it's not a big deal, I don't think. There's been some economic data slowdown, number 7. Last week was on non-farm payroll and ISM, Institute of Supply Management. We're seeing data slow down. And the big question out there is recession, Kyle. Like, are we heading into recession? And if so, is the Fed behind the curve and not decreasing interest rates enough? And again, just stop me anytime, jump in if you want to throw a harness over me. Powell, I think in the last FOMC meeting, he was very dismissive, and I would say he was almost he was defensive in terms of when he was pressed, is he going to cut interest rates in September? And he says, we have not made a decision. We're data dependent. We don't know. And we'd already seen the market start to roll over a little bit, and we've seen economic data that was weak. And being that he took almost a defiant tone, which I think is a little unlike him, I don't think he played his hand well. I think the market is not happy with that performance. And circling back to number 5, seasonality is real. And what that means is August is traditionally a weak month in September, but it's the summer. It's thin. A lot of traders are gone. A lot of guys are out. They're in the south of France. They're in the Hamptons. They're, in, wherever. It's been a busy year. They know it's going to be a busy end of the year with the election. So I think a lot of people are gone. So that tends to create very outsized, large, whippy moves in the market. So, when Powell came out and wasn't very accommodative in terms of where they were going to be in September, the market, the fixed income market, which we'll take a look at, really took Powell to task. And we saw a huge move down in rates, which is the market trying to force the Fed's hand that they have to cut rates. And there's been so much talk. I listened to CNBC the whole way up, and I did actually an interview. I stopped along the highway and did an interview with Ben Zinga. And we're talking about the possibility of an intra-meeting emergency cut, and probably not going to be the case. But the market is pricing 150 basis points of cuts, which is 1.5% over the next year. So I do think the Fed is gonna fall in line. And go ahead.
Yeah, I agree with the Fed. I think before they were fighting inflation, and unemployment was well within a healthy range. So they were playing both fields, but now you have unemployment at 4.3. Now you still have higher inflation, even though it's been receding. So now there are 2 reasons basically to cut rates. It just raises the certainty that that's going to happen.
Yep. Well said. And then on top of this, there's a lot of things hitting the market. And then we have this yen carry trade. And I just got done doing a video for the research customers at Trading Analysis. And, I know we have varying degrees of, let's call it sophistication. Some people, all they do is spend time in the markets. And we have other investors who, spend their time, rightfully so, in other more productive industries and environments. And they have no idea what the heck a yen carry trade is. So, real quick, basically what it is Japan has been fighting deflation because of their demographics for a long period of time, and I would say lack of innovation. So it's falling prices. So they really can't raise interest rates, and they've been low for a long period of time. So what traders and global macro investors do is they borrow yen at a very cheap price, 1% or 0.5%. They take that money, invest overseas at 2, 3, 4, 5%, and make the difference. They arbitrage it. And that's great. And one of the things was international investors borrowing money out of Japan, selling yen, buying dollars to buy U.S. tech stocks and Mag 7. And that was great. They're making money on the interest rate differential or the growth, I would say, in the stocks. And that's great until they start to roll over. Then they got to sell the stocks, undo that yen carry trade, and send the yen back to Japan, which is covering the short, which means it starts to be bid. Okay. Let me just turn this off here for 30 minutes. Okay. So, this is what happened back in 2008 during the global financial crisis. The yen carry trade was going on. The housing crisis started. I'm getting some feedback. I'm going to just mute you for a sec, Kyle. Okay. There we go. So, and I'll come back to you here just one sec. So, the housing crisis started in the U.S., spread to other markets, and started to impact global markets. And there was a lot of traders and investors who had the yen carry trade on, and the yen, the same thing happened back in '08. And I'm not saying this is another global financial crisis. I think it's far from it, but the result was the yen carry trade came off, and that's one of the things that is driving volatility. The Nikkei, as a result, has been going up, and I'll show you charts of that as well. But we're definitely getting the Nikkei was come out of decades long of deflation, starting to reflate a little bit. The economy is improving, the Nikkei has gone up, but it's driven the exchange rate in a direction that it became too stretched, and it's snapping back, and it's adding to the volatility. So I think, we're getting hit from 8 different sides right now. None of it is so significant that, none of it is so bad that I think, we're going to go into a sustained bear market. There's 8 tripwires that are right in front of us. Again, Buffett reducing Apple, Nvidia chip delay. Iran, Israel certainly could escalate into something much more significant, but for now it's not. I think domestic politics are uncertain. Seasonality is a problem. Concern over earnings with AI infrastructure spend. Fed behind the curve with recent economic slowdown. Are we going to recession? And will the Fed respond based on what the market wants and the yen carry trade? So there's 8 different things that are happening right here, but none of them I think are so significant that it's going to sink the market. There's just 8 annoying sort of flies hanging around us right now, and I don't ever want to consider a geopolitical horrible situation like Iran and Israel to be an annoying situation. It's not. That's not what I'm saying at all. But right now, it's not enough of a driver that it's going to derail the rally. It could certainly escalate into something more. Okay. So, yeah, as we said, Buffett cut his position. He dumped 49% of the stock. Berkshire Hathaway disclosed in its earnings filing that its Apple holding valued at $84 billion of the second quarter. So he had double that, $160 billion position in Apple, which is amazing. Now, I'm going to turn it. Okay. Now they're sitting on $270 billion in cash. So where's he going to go with that? Sorry, that text needs to come out of there. And again, this is not a properly done presentation just because of time. I hope you guys understand that. So please excuse some mistakes in here. But Apple coming off is quite significant. The seasonality, I think, is also part of it. And we're getting some feedback on you, Kyle. I might have to. There you go. Yeah, just mute when you want to hop in. Just jump in there. Thanks, man. So what we're looking at here is the seasonality of the Nasdaq, S&P, Dow. So August for the Nasdaq is one of the weaker months. This goes back from 1986 to 2024. It's about on average up about 0.5%, but then September is the only historically negative month in the Nasdaq, and the same thing with the S&P. We have a moderate negative average performance from 1950 to 2024. September is clearly negative. Okay, Dow clearly negative, and it looks like May is also a negative month. This is going back 1929 to 2024. So you got 95 years, and you can see September is quite a negative month. So I almost wonder if we're kind of pulling that ahead a little bit. Is that a guaranteed sign of things to come? No, I don't think so, but it's something we need to be aware of. And as you get stock market volatility or sell-offs, obviously the VIX, or that measures the uncertainty, or they call it the fear gauge. It's basically a measure of how expensive options are at the money in the S&P. And the more expensive options are, the more expensive a premium, insurance premium, is going to be. And if the house is on fire at the, it's smoking at the base, your insurance premiums are going to go up, to insure against fire. So, as things become uncertain, the VIX, or the level of option pricing, increases. And you can see the biggest spikes are in August and September. And we're certainly seeing that right now. And we'll talk about the VIX. The VIX got to the highest level, to a level that was on par this morning. It got on par to the global financial crisis and the global pandemic, 2009 and 2020. We saw a VIX of 65 this morning, which has not been seen except from those two occasions. And again, I think we're a long way away from a GFC or a pandemic. Okay. And then everything else is pretty quiet. This is treasuries, here's gold, here's crude, and here's the dollar. Okay. All right, so let's just take a look at, here's the S&P 500. Just look at it on a chart. Love looking at the technicals. And so there's two moving averages on here. So this is the S&P going back to, this is going to be, I cut the date off, right in the middle of 2023. Okay, so this is 23 and then into 24. So we broke below the gray 50 period moving average. So we held it for the last 2 weeks. And then, which is pretty interesting, we got a gap down on Friday, and a gap is the existence of the price bars not touching on Friday, and then we got a gap down this morning. So the average price of the last 50 days in the S&P is the gray dotted line, and then this is the 200-day moving average, the average price of the last 200 closing prices. And you can see since 23, the 200-day moving average held as support. It's not a particular level. It's we really need to hold 5,011 in the S&P, but it's an area of support. It's a zone. And here in 23, late 23, the market got below the 200-day, but got back above it, and we've been cruising higher since. So, all the technicals that we do behind the scenes with Elliott Wave and all the voodoo technicals, there's a pretty good zone of support from a couple different levels, right around the 5,000 mark in the S&P. So, we did snap back. We can take a look at the market right now on a price chart. Let's pull this over. Sorry, Kyle, we got to get you a better microphone as you get broadcasting. So let's just take a look at what the market did at the close here. So let's go to a 60-minute chart. So this is going to be today's price action. So each one of these bars is 1 hour of trading today. So this is the S&P 500. We opened down, rallied back up around lunchtime, sold off a little bit into the close today, and then finished kind of on the high of this last hour. So it was a constructive day. It was a constructive day. I also don't think the volume was that significant today. I'll have to look. It was pretty large. We did a lot on the close. In the last hour, it wasn't significant, but it looks like we did quite a bit on the close. So I'll take that back. Volume was quite significant. But, I mean, looking back, so, 140 million shares of the SPY. This is the ETF that tracks the S&P 500. We did more in March and April on this little sell-off of 23. You can see those guys are doing 150, 160 million, where we did 140 today. So, it's elevated, but it's not like we've seen in prior sell-offs. Okay. Let's look at the same thing in the NASDAQ, the QQQ. This is the NASDAQ 100 ETF tracking stock. This was not big. That's actually quite surprising. There certainly was more volume done in the SPY, but the NASDAQ ETF really didn't print a lot of volume today. So that's kind of interesting. So, back to this chart, this blue line is, distance from the moving average, from the 200 period moving average. So we're about 4% away from the 200 period moving average, and we've seen in the past that we can dip below it, and we very may well do that this time. But it's certainly an area of support that we want to keep an eye on. The NASDAQ, so this is the NASDAQ 100, not the S&P 500, the NASDAQ 100, has tested the 200-day moving average. And the 200-day moving average has been in play since early 2023. We've been riding above it. We just came back to test it. And the fact that we closed back above it today, I think, is constructive. So if we go over here, oh, come here. Index. So that purple line right there is the 200-day moving average on the NASDAQ. And we opened below it this morning, but then with this little dash on the end of this candle, that means we closed here today. So the way this works is we opened the day this morning at 9:30. We were down here at 17,000. The intraday high today was up here at 18,001, and then we closed off of the lows here at 17,895, which again is above the 200-day moving average. So I would say that's constructive as well. And I think the big thing that we want to also keep in mind in the world of technicals before we move on is when you have an old high or low, the highlighted area is known as resistance. Okay, so when we were coming up to retest the old highs, it was resistance. We held it for a week or two in here, and then we broke above it. And now what happens is the area, it's like the artist formerly known as resistance, when broken, becomes support. So, it already held support back here in April. We traded up here in July. This is the sell-off we've seen. And, we are still above this support level in the NASDAQ 100. And I think, while this zone of support is still intact, the market is still in an uptrend. And again, I don't think that, any of the 8 reasons so far are enough, or even collectively together are enough to derail what's happening. Like, earnings continue to be solid. There is concern about the spend on AI. Interest rates are dropping. And in fact, I want to go into, after we look at the VIX, the volatility index, I want to look at interest rates. Interest rates are dropping. The yield curve is coming out of inversion, which is a good thing. Usually yield curve and inversion signals recession. And the markets are nervous because we have had an economic slowdown, but the Fed maybe is behind the curve and not decreasing interest rates enough in response to inflation coming off post-pandemic. And we have to keep in mind that interest rates were not elevated to cool off an overheated economy following pandemic. Interest rates were increased to deal with supply constraints. The world shut down in the pandemic, which killed supply chains and manufacturing and services, and just there wasn't enough goods and services available. It wasn't overheated demand, it was under supply. That dynamic is coming off, and the market is telling the Fed, you need to address that and undo these very restrictive, tight, elevated interest rates to combat inflation that again was a result of supply constraints rather than overheated demand. So I think we're good there. And again, Kyle, I hate to anything.
Yeah. Am I still feedback? We got a comment that I'm sounding okay, so tell me how I sound now.
My sound is okay. You sound good. Yeah.
Okay.
Let me turn mine up then. Gain. Test. Oh yeah, I see that. Okay. Test.
You're a little louder to me now.
Okay. Okay. Yeah, you're good now. Thanks. Sorry about that.
Cool.
Again, this kind
Okay,
of
cool. I can
this.
talk again. Yeah, no.
Sorry, man. Go ahead.
I agree, and I think the dollar weakening. I think that helps in a lot of ways. So you can look at this carry trade unwind and a positive
Yes.
aspect too. That'll help
Yes.
exports, and I think there's definitely some resilience. I think the biggest risk is the economy slowing down, and a lot of that will be helped by rates getting lowered. But I think that's probably the biggest risk out of a lot of elevated risk. I think that's the thing that is driving a lot, because I mean, if you see unemployment go up, you think about GDP, and the U.S. consumer, they say it's like 70% of the
Mm-hmm.
GDP is just people spending, and
Yep.
if people can't work, then they can't spend, and that hits company earnings. I think that's the risk. You look for the Fed and the Congress and everyone to take steps to prevent that when things do cool off too much. Um, I can't speak for Congress, but I think on like the Fed side, they have some kind of like some ammunition to help the economy when it needs it. They
Yep.
can take rates off. They can increase quantitative easing back open. So they have kind of all those tools in their arsenal right now, I think, and that kind of makes me feel better about them managing. You want to decrease rates without messing up the economy, either by going too fast or too slow. So I think that's just kind of the live experiment we're going through right now, is that easing of rates.
Right. Right. Yep. Well said. We'll get into that. We'll look at rates, and as you just mentioned, like it started last week with some slowing data. So Tuesday of last week, we got some Case-Shiller housing data, which was a little strong. Consumers' confidence, interestingly, was above expectations. Came in at 100.3, where they were looking for 99.7. Jolts 8.18, close to it's better than the 8.02 on jobs. And then ADP, non-farm payroll, came in low. Employment cost low. PMI was good. Home sales way up. And then the Fed came out Wednesday, and Powell was really, as I said, I thought he was pretty dodgy on Wednesday, really kind of taking a hard line, saying we're not doing we don't know in September, we haven't made a decision. And then we got some weak ISM data here on Thursday. Institute of Supply Management and Manufacturing came in low. PMIs came in low, but the prices were above. So we had sort of a stagflationary message there Thursday. And then the jobs report was weak. So average hourly earnings was lower year over year, month over month. And then non-farm payroll came in at 114. And, if you look at this guy, there should be a chart popping up here. You see the jobs trend has actually been decreasing. And I don't love the look. Stop. I don't love the look of this. You look at the trend from 21, 22, 23, 24. The trend of non-farm payroll has been lower. And then there is concern how much, are government workers versus private. And we can certainly look at the private payrolls, which are right here. And that'll take a second to load. But yeah, that jobs report that was below expectations. So now the fear is, are we coming into an economic slowdown, which I think the collective agreement is because inflation continues to be too strong, particularly in the supermarket for food. That needs to be addressed. Energy is not really an issue right here. Crude's at 75, which it probably should be at 60, 65 without tensions in the Middle East. So I don't think energy is a big problem. I think food is a big one, and then insurance is a big one as well. That's driving
Yeah.
CPI. Go ahead.
I was just going to echo that. Like car insurance is up 20% this year, and all insurance just is spiking. And yeah, that's
Yep.
we need. I guess we need to research that more because I don't know if you've looked into it, but I don't really understand the why there.
Well, yeah, I mean, it definitely has to do with interest rates being higher, and you know, it's the model, it's the business model of insurance companies. We'll get into rates, but here's private payrolls, which also have been in a pretty steady decline. So, you know, that's a little concerning. I mean, yeah, 21, 22 was a different time.
Yeah,
But
the pandemic added a lot of just weirdness to the labor market because everyone had to quit or go home, and then companies were over hiring and trying to like hoard good workers in a lot of cases, and then now it's kind of like cooled off from that. So
right, yeah.
there's a definite in the immediate aftermath or during the pandemic, there was a huge spike that was pretty unnatural.
Yep. Well said. Well said. Okay. So that's what's going on. Let's take a look at where the Fed is right now. We are looking at, let's just do for the meeting coming up. So September 18th is the next meeting. We have all of August, and you know, we have what, 25, 26 days left in August. It could be a long month, or it could be a very sideways month. We'll see. We'll see, you know, if any of those 8 dynamics that I mentioned continue to push volatility. But we are right now at 100% chance of a rate cut in September. We're only at an 18.5% chance currently that it's only going to be 0.25%. We're at an 81% chance that it's going to be 0.50, 50 basis points. And if we look out to the probabilities over coming meetings, we are, you know, the blue is the best odds of where it's going to be at that meeting. So for September, we'll go, right now they're pricing 50 basis points. So there's an 81% chance of a 0.50 cut to the Fed funds rate, which would bring us from 5.25 to 5.5 range down to 4.75 to 5.0. Okay, and then November, best odds for another 25 basis points to 4.5. So right now we're looking at, call that 2 cuts, 3, 4, 5, 6, 7 cuts into this time next year. Now, we've seen this movie before where the market was pricing in 6 cuts. They took it off, they went to 2 cuts and then 1 cut and then no cut, and now it's come back on. So this thing can change. This trades just like, you know, shares of Apple. So right now we have, currently they're pricing in 50 basis points, 75, 100, 125, 150, 175, which is 1.75% lower. So if Fed funds goes from 5.25 down to, you know, 3.5, 3.75, that's okay. You know, and that's where we probably should be because inflation right now is that's roughly where we are. You know, we're 2.5 or 3%. And I'm trying to load up pricing yield spread. That'll take a second to load that guy. Doesn't want to load. Okay, so that's that. Let's take a look at the VIX, and then I want to go into yield curve. So what we're looking at here is this is the volatility index. This is the fear gauge, so-called fear gauge. It's the level of option pricing in the S&P. The bumpier or more volatile the S&P or the stock market becomes, the more expensive option premiums are, which is just insurance premiums. Right? So you're going to see a pretty good inverse relationship between the S&P in blue and the VIX. And as the S&P was dropping here in 2022 and 23, the VIX was going from 15 to 17 to 25 to 30 up here, right? And then here's the pandemic. S&P sold off in blue and the VIX ripped. This morning, Kyle, it was crazy, man. We got up to 65 VIX this morning. That is as high as we saw in the pandemic and the global financial crisis. The GFC was a 89 VIX. The pandemic was an 85 VIX. This morning we got to 65. I think we're a long ways away from a global pandemic or the global economy being shut down from way overly leveraged mortgage products. There is a degree of illiquid August seasonality to this, and we don't have significant technical damage done to this market. The market is just nervous. And here's what the market actually looked like. I'm going to get down to the intraday chart of VIX. So, I woke up this morning, it was like right about here, 38. It was about 4 a.m. Jumped in the ocean about here, it was about 40. Jumped in the car here, probably my third coffee, we're at a 51 VIX. And we got up like 8 a.m. this morning, 8:30, we got up to a 66 VIX. And then it started to back off. And the market opened right here at about a 45 VIX. And the volatility was dropping throughout most of the day. And what the S&P is, we already showed you, it opened down, traded up this morning till about lunchtime, sold off into the close, but didn't make new lows. So we need to watch where that VIX goes. And that's something that you're going to hear a lot about. It's about 38 right now. We want the VIX to drop. And if it breaks these lows at about 30, you're probably going to see the stock market continuing higher. So we need to watch where that volatility or the uncertainty in the market is. Okay. But I just can't help but just remind you guys, the VIX this morning was on global pandemic, global financial market shutdown from the GFC. We're a long ways away from that. Unless the market is pricing in something that we don't know yet, I think this is a much different environment. The Fed is going to respond. They're going to cut rates, et cetera, et cetera. The generative AI boom, we're literally in the next industrial revolution. Nothing's changed. And the earnings have been solid. The S&P is going to make $250, $260 a share this year. A year ago, 2 years ago, analysts were saying we weren't going to make $200 a share this year. Earnings have been good. And just part of it, Kyle, is I'm going through and studying what the AI infrastructure build out means for margins and free cash flow. We're getting in and understanding exactly how CPUs, central processing units, and GPUs, graphic processors, and TPUs, and all these different, all the different technologies that these companies are building and investing in. It's pretty crazy. We're really trying to get our mind around what it exactly is and how it's going to drive earnings and productivity, increase margins to justify the valuations. And I think part of it, Kyle, is people don't understand what we're actually doing right now, myself included. I'm studying and I have an idea what's going on, but I think most people have no idea actually what's going on. And Steve Eisman, who was the Big Short, he was the guy in the Big Short. He said it great on CNBC. He's like, July 11th or 12th with a low CPI report, interest rates are dropping. People just woke up and they're like, I think I've come far enough with this growth trade and the Mag 7. I want to take some profits and rotate into small domestic companies on the Russell 2000. And he's like, it was just a psychology shift. And this thing has kind of fed on itself as the market's tried to move into small caps, and just that we've come too far in the growth trade. Well, go ahead.
Yeah, it does seem like a sanity check just because of how far the AI stocks and tech stocks have gone compared to everything else,
Yep. Yeah,
At some point, there's going to be some rebalancing. Yeah.
Yeah. And to put the chart, and again, this is, to our inside edge investors, normally I don't throw the heavy voodoo charting that I do at you, but I mean, this is a volatile market. I'm just going to, handicap it the best I can. But, this is Nvidia coming from 2022. And we have a 6% allocation in Nvidia in TAG, Technical Alpha Growth, but I've got 2% sidelined that I intend to put into Nvidia. So we had 2% cash, and I'm kind of watching it. You might think I'm out of my mind. I'm sure you do. And you're like, Todd, Nvidia's off the highs so much. Yeah, Nvidia's 26% off of the highs. At the max, it was down about 35, maybe 40% from the highs. But this stock from late 22, less than 2 years, this stock is up 850%. This year alone, the stock is up, what? 108% this year. Max this year was up 185%. The stock's up 100, even with the sell-off, the stock's up 108% this year. So for this thing come off 40%, it's very normal after 100% run just this year. And from the low of this move, this stock's up 850%. So you got to think about it in percent moves. And I hate seeing our shares go from 140 down to sub 100, but we just bounced back. The technical model I look at, we have support down into the 85 to 86 area. And we may have seen the low in Nvidia. We may. And what I like is this bar, we opened down at $90 in Nvidia. We traded down to about 90, 60. Traded as high today as 103 and closed at 101 and change. So we closed off of the low of the day into this highlighted zone of support. We might be close, Kyle. And if we start breaking through 85 in Nvidia, okay, we have problems. But while we're above 85, we're good. And I'll spin through a couple other heavyweights for you. Apple. And again, I don't normally like to show the voodoo crazy technicals we do, but oh, what the heck is that? Apple. Just the same concept. From 2023, we had a double top up here at $199, $200. We broke above it on a beautiful earnings report. Remember, what was resistance or a ceiling, when broken, flips to offer support. And look at the action today, Kyle. We opened down, and the dash to the left is the opening price. We tried to break below 200. We went down to like 197, and then all day, Apple traded back up to 213. We closed at 210. So we just held the $200 level in Apple. That's a big breakout on news that Buffett dumped half his shares. And what they do, they tried to sell Apple off, but closed it up at the high of the day. And this is, we can go down to a 5-minute chart, just show you the intraday action. So this morning opened down around 197 and then immediately came in, bought it up, sold off a little bit into the afternoon, and then closed right back up here. So that is not a bad day in Apple. Another one, you guys also are going to think I'm crazy, which is fine. Tesla. Tesla's actually starting to find its footing. We have support in Tesla just below 200, down into the 170s, 160s. If we can hold the 170, 160 in Tesla, it might be time to reintroduce Tesla in the portfolio. Another one is Meta. I really like this technical pattern in Meta. Again, I'm showing you some of the voodoo that I do. But we have a good zone of support in Meta around 460, 440. And again, I really like the price action this morning. It opened down at 450, closed today right at that dash at 475. While we're above $450 in Meta, I think it looks good. And we've got a few other. Google doesn't look bad. I think we have Google also holding into the 200-day moving average and uptrend line. Google held some support. Amazon held some support. So I don't think all hope is lost here at all. Let me go over and just, again, sorry to go on a tear here. U.S. yields, U.S. 10-year yields. This has been the big driver. U.S. 10-year yields, this is one day. The yields went from about 4.1. It's not showing me the proper scale, but you can see it, 4.1 down below 4, 3.9. This morning we traded down to 3.69% in the 10-year yield. 10-year yield is what drives most interest rates in the economy, with credit card and home loans, auto loans. That's the driver. That's sort of the heartbeat of America in terms of interest rates. And the rates dropped quickly. And what's also happening is the 10-year yield is more market driven, where the 2-year yield is reflective of where the Fed is going. And the 2-year yield has also been dropping sharply. So the 2-year yield is reflective of where it thinks the Fed is going, as the Fed influences short-term yields, 2-year and less, where the 10-year, as I mentioned, is more open market driven. And the 2-year yield has been dropping sharper than the 10-year. The black is the 2-year, blue is the 10-year. And what the 2-year dropping faster than the 10-year, what that's done is that's taken the yield curve out of inversion. And as we look at the 10-2 yield curve, anything below this dotted line is inversion. Well, we actually, for the first time since June of 22, we got out of yield curve inversion briefly today. Above that line, this yellow highlighted line is out of yield curve inversion, heading towards a normal yield curve. So, with yields dropping so quickly in response to the market basically throwing a hissy fit saying, Powell, you got to cut rates. You have to cut rates. The economy's finally starting to slow down a little bit. It's bringing the yield curve out of inversion. You combine that with what I think is pretty good earnings. I think a lot of people don't understand exactly what the implications are of this AI infrastructure spend and what the ROI is going to be on it, and are we really going to see a quick return on it? But none of this is really, I think, alarming that's going to take us off, unless the market is pricing in something significant that we can't know about yet, unless Iran and Israel is really going to escalate and we're heading into something messy. It could be. But Kyle, I mean, if we were, why is crude as quiet as it could be?
Yeah, it would be going to the moon if that was true.
Crude is boring right now.
Yeah.
It sold off. I mean, it's more reflective of maybe a coming slowdown, maybe starting to price in recession. Like, crude's not doing anything. Crude's not doing anything. And I'm watching the polls, not a political statement, but Trump is also stabilizing after his decline after the assassination attempt. He was, heavily the favorite. I'll show you the polls. Research. Not the polls, the betting odds. Real Clear Politics. I mean, this is not the end-all, be-all, but this was the bump with Trump after the assassination attempt. He was 65. What was the high? Probably 65. It came off down to 50. And then he's got a little bit of a bump, and Kamala, who's come on so hard, it started to roll over a little bit. And the only reason I bring that up is Trump has said, drill, baby, drill, which he's going to flood the economy. He's going to flood the crude oil supply. And his goal is to get inflation down as quickly as he can, and that's going to be by flooding the market with energy. So as if Trump ticks up in the polls, I think you're going to see crude oil continue to be under pressure, maybe more so than crude oil reflecting a slowing economy and slowing consumer. But if things escalate in the Middle East, I expect to see 80, 85 crude. And then if you start breaking out above 85, technically you're like, okay, now we have a problem on energy. But it's not doing that. So let's see, what else do I have in here? Okay. The carry trade. Let me check. Do we have any comments, question? Everyone nice and bored? Yeah, I'll take a look at Bitcoin as well. Okay. So we talked about the carry trade, but this just goes to show how tight the exchange rate between the US dollar and yen and the NASDAQ is. And again, what's happening is global investors, you don't need to be a Japanese investor, any macro guy, hedge fund. What they do is they borrow yen cheaply. They sell the yen that they borrowed from a Japanese bank. They buy dollars to buy U.S. stocks, or they go buy Australian bonds at 5%, or Norway, or an energy producer, or a higher beta economy. They borrow cheaply and invest overseas a higher rate and make that interest rate differential or arbitrage it. So you can see the correlation as the NASDAQ was going higher, the buying of dollars and selling of yen was following very closely. Well, all of a sudden NASDAQ came off and dollar yen came off, which means dollars are now being sold, yen's being bought because that yen needs to be bought back and returned to the bank they borrowed from in Japan. Well, it's funny. Like, I used to trade FX for a hedge fund during the global financial crisis, and the same thing was happening. The yen carry unwind. But what drives me nuts about FX markets is people were bitching so much about the yen being so weak and the disastrous yen at 160. Okay, now we just came off, and now we're at 143. Now people are complaining about the yen being too strong. I mean, a month and a half ago it was too weak. Now it's too strong. It's like, it's just symbolic of this August kind of whippy market, and people don't know, there's, like I said, there's 8 factors that are driving this market a little bonkers. And I hate to put, a horrible, potential conflict, in that bucket, but right now it hasn't escalated, and it still is something that's buzzing around the market's concern, but it certainly could escalate. But, yeah, I mean, again, the yen was too weak for everyone, and the Bank of Japan was being pressed. Now the yen's too strong because the carry trade's coming off, but it's still very much in an uptrend. And the other thing is, again, leaning on global macro, and we've talked a lot about U.S. yields. You could see the correlation of the U.S. 10-year yield, which again sets auto loans, it sets credit card rates, it sets 30-year fixed mortgage rates. I mean, that's the interest rate that drives so much in the American economy. You can see the correlation with the yen. And this is a long story, but again, the higher our yields, the more you can make in a U.S. investment, 3%, 4%, 4.6%, 5%, the more people are going to sell yen, take cheap yen out of Japan, buy the U.S. to buy our treasuries at 5%, and make that interest rate differential. Right? So you can see as yields go up, dollars being bought, yen's being sold. And you said it correctly, Kyle, that, okay, well, if the dollar got too strong because we have so many large multinationals making money overseas that have to repatriate back home, if the dollar gets too strong, they're bringing less earnings home. And you're right, the dollar's now getting weaker because the yen carry trade's coming off, and that's good for our multinationals. That's good for Apple, and that's good for Nvidia, who's selling chips overseas. Like, if the dollar's weakening up, they're bringing more profits home. But they don't like it because the yen carry trade is coming off. But it's also dropping U.S. yields. Look at the correlation. Last month, Kyle, as soon as U.S. 10-year yields ticked down, stocks went up. The algos bid up stocks. Now, again, it's kind of a weird August month. Rates drop, and the markets are taking like it's an economic slowdown and to sell stocks. Last month, it was a good thing. This month, it's not a good thing. Telling you, it's a little bit of whippy August seasonality going on here, and I hate to dismiss it, but I really feel like that's what's going on here. So, all right, let me take a breather. Step in there. Tell me what's going on with you.
Yeah, fair assessment. Fair assessment. I think I would just add, on the fixed income side, we made a couple changes.
Yep.
So just dropping some of our tips. We still have some. Dropping some high yield. Just the economic concerns can cause some pressure there. And then going a little bit longer on duration. So getting some longer terms when rates drop, that can help returns because the older longer term bonds are worth more than the same bond getting sold today at a lower interest rate. So just making some small changes to adjust to the economy.
How much did you reduce tips again? What percent?
It went from 15 to 10.
Okay, nice.
That's the percent of the full model.
Nice. And we get into this sometimes. Let me see if I can pull this over. Start snip. This is pretty heady, wonky stuff, but back to that yield curve discussion and discussion of real and nominal. So when you factor in expected inflation, come on, where are we? There we go. Oops. Okay. So the yield curve is, again, the difference between the 10 and 2-year yield. And when the 2-year yield is higher than the 10-year yield, that creates the yield curve inversion. And traditionally, when you get that, you move into recession, which is the gray shaded area. And the last 2 times, yeah, the stock market in blue did sell off.
Make sure you're sharing.
Oh, thank you.
Yeah.
I have such a bad habit of that. So again, this is the 10-2. So difference between 10-year yield and 2-year yield right here. And if the 2-year yield is higher than the 10-year yield, that's yield curve inversion. And the red is inversion. Well, we're coming out of that. And we have seen times where we did go negative. The gray shaded area is recession, and the stock market in blue did sell off. So we had inversion in 2000 and 2008, which led into recession and the stock market selling off. However, there are plenty of times where, yeah, we got yield curve inversion, we went into recession, but the stock market went higher. Yield curve inversion, recession, stock market higher. You know, yield curve inversion, recession, stock market went higher. So we have the most recent 2 times where, yeah, you got yield curve inversion, but the last 2, yes, saw a lower stock market because you had a tech bubble and you had a housing crisis. Well, there's plenty of examples prior to 2000 that was not the case. And then if you look at the real yield curve, which Kyle was just mentioning, we reduced our TIPS exposure because inflation is coming down. If you look at 10-year yields with expected inflation, which is calculated by the central bank factored in, subtracted from the 2-year yield, which is tracking Fed funds, factoring in where inflation is projected to be, the so-called real yield curve, we've gone positive. And good things happen after your real 10-2 yield spread comes out of inversion. The 12 and 24-month returns of the stock market are positive. So inflation is coming off. I wanted to show you 10s and 2s. 10 and 2 year, yeah. Okay. So, look at U.S. 2-year yields. Oops, in red is U.S. 2-year yields. I just blew it up. On top of that, in blue is the 2-year expected inflation rate published by the, I think it's, the St. Louis Fed. So you can see the 2-year yield has been rallying up to 4.2 area, where the 2-year expected inflation has made a lower high. It's at 2.5%. Big spread between the two. So inflation, where it's expected to be, is right where the Fed wants it to be. So the rates are too tight. They're too tight right now. This is going to be basically your Fed funds rate subtracted from 2-year yield. 2-year yield right now is about as high above the 3-month, which is reflective of the Fed, as it's been. So, we need to get rates down, and that's what the market is really telling us. So, okay, we're going to leave that one there. 2-year, yep, we looked at that one as well. Okay, that's good. Crude, we looked at. The dollar, we looked at. I don't think we did, but you mentioned the dollar. The dollar is moving lower, which Kyle said is a good thing, and that's absolutely correct. The chart work we do, I think the dollar might start to find some support in this zone. This is a basket of currencies against the U.S. dollar to give us the collective dollar index, like the S&P index. The dollar, I think, needs to find some support right here, because that's going to take some pressure off of stocks from this so-called yen carry unwind. This is dollar against yen selling off. If this thing can find some support, that's going to ease off this yen carry that everyone's talking about. And I think you can just simply refer back to this highlighted area that shows we have support in this dollar index product at about 101. If we can get a little bit of a bounce here, I think the yen carry is gonna start to come off. And just to round out the conversation, like, this is Aussie yen, right? So yen, we know, is a cheap currency to borrow, and Australia is a higher yielding currency. You can see the Aussie yen has come off sharply. Look at the correlation with the Mag 7 ETF over Aussie yen, over the So this is the whole concept that everyone was talking about. I know it's a very abstract concept for investors, but it's just this idea of borrowing cheaply in Japan and going overseas and finding attractive investments. So that's what's going on. And I think, let me just check notes. I think that hit most of what we wanted to do. Is there anything we left out, Kyle?
Not that I know of.
Okay.
I think that was pretty. We kept it to 20 minutes and change.
Oh, good. Good. I doubt that. Was it 20 minutes?
It was an hour.
Oh, jeez. Just like that.
Yeah.
Shut up, Kyle.
There's a lot to talk about.
I'm sorry. I think that's
a lot going on.
There's a lot going on, man. It really is. I think we hit it all. AI spend. We're going to have a report going out to you guys. Trevor, the intern's been working hard on that. Really good work he's doing. We're working on that. Fed behind the curve, yen carry trade, seasonality, domestic politics, geopolitics with Iran, Israel, Nvidia, Buffett. Man, I think that's about all we can handle right now.
Yeah, and kind of the summary, I guess, if you're in our equity models, like, we're watching lower support levels, but no changes yet based on the last couple days.
Yep. And some investors asked about hedging, which we do on a basis for individual investors. We can't do it now with the VIX high at a 30, 35 VIX. Insurance is too expensive right now to do it. So if my generally optimistic outlook disintegrates, we will manage our exposure at the model level, meaning I will reduce holdings, we'll be more defensive, and we'll be watching very, very closely. So, there was no question to cut vacation short and come home and do it. So we're going to be taking it day by day. I don't want you to think I'm being dismissive of the risks out there. There's 8 things that I think we laid out. Any one of them or any combination of them can escalate, and we're going to be watching. But right now, I don't think it's enough to derail what's going on. I still think we're very much underway of the next industrial revolution. We're rewiring the way the internet works, and it's changing the way that businesses transact. They're operating more efficiently, and we're just building the hardware right now. Software will come 2, 3, 4, 5 years later. Last time when the America literally came online, Kyle, it was like Cisco and I forgot who else in the 90s, and then it wasn't until like 2010, 11, 12. Where the software stocks came on, Google and Facebook and Microsoft. It was 10 years before software got going. I don't think it's going to be as long this time, but we're literally rebuilding the infrastructure of the internet now. Software stocks will come on in 2 to 3 years, and this thing could go for 5, 7, 8 years. I don't think anything has changed. The Fed needs to readjust the very high monetary policy in response to the pandemic. They need to unwind that at this point because inflation is on the glide path lower, and they can't wait for it to start printing 2% for them to start cutting rates. It's too late at that point.
Yeah, and Powell, I guess, luckily he's indicated that already, so he gets it, we think.
Yeah. I think he's going to have a different tone than he did in the last FOMC meeting. Austin Goolsbee, new Fed president, came out and said that we're gonna have to address this. So we're watching. We are watching. So Investors, please let us know if you have any comments, questions. If you want to talk to us, obviously just reach out to Kyle or I, and we'll hop on. But we're watching closely, and check us out at Inside Edge Capital if you feel like perhaps the current organization that is watching your very important nest egg in your life's work are perhaps not as focused on it as they should be. Maybe check us out. I do want to make sure we saw disclosures as well. I do want to make sure that we flash those up. What else? So yeah, we work with we work with clients of all ages. We have I think a pretty unique skill set of active portfolio management on my end. Kyle, being a CFP, certified financial planner, he's running the fixed income portfolios with my input. He's doing a great job. So we're active management. We rebalance, reallocate portfolios depending on the market 6, 7, 8 times a year. We are sensitive of tax consequences, but planning is especially important to understand where you are with your risk, your buckets of your portfolios. Like, what's the time frame you're going to be in there? What's your true risk tolerance? What's this money intended for? And these are really important questions that Kyle will take you through. And only after you go through that process can you properly be placed in the right portfolios. And that's where I go to work and I watch the market as closely as I ever have. But we're longer term. We're trying to ride this bull market as long as we can. And if things continue to get bumpy, we're gonna get defensive, and just like we did in 21 and 22. So that's who we are. That's us.
That's a wrap. I mean, that's what we're about. We want to help you reach your financial objectives, and you combine the portfolio management with the financial planning, the advising, and you get the whole piece of the pie. And you can make sure you're looking at everything, taking advantage of strategies available to you. Make sure you're not under aggressive with your portfolio, and that's it takes a partnership to kind of gain that understanding. And so we focus really hard on that. We want to work closely with our clients, make sure we're all on the same page, and if we know we're on the same page before we get crazy market volatility that we've seen like this, if you know where you're at beforehand, then you go into periods like that way more confident and prepared, and kind of see the bigger picture.
Yeah, it's so. And I see your questions on gold and Bitcoin. I'll take a look at those. But what Kyle said is so important. Like a plan, especially if in an actively managed portfolio situation, financial plan and understanding of your risk tolerance and what a drawdown is going to look like and what it means to you for your future plans. Like, you have to get that out in the open early. And only then can you go into a busy market like this, which I think has a lot of upside, but there's obviously a lot of volatility where you got to be prepared to handle whatever is thrown our way. And just you're rest assured that Kyle and I just came home from a vacation early because the markets are busy in the beginning of August. So we have our eye on the ball very much. So great question on gold. Gold had a shot. We have some gold miners, and they're doing fine. But gold had its shot to be an inflation hedge. And gold had its shot to be a safe haven in times of market volatility, and it's failed at both. Gold right now is trading just like a risk-on growth stock. The same conditions, the same global macro conditions that send stocks higher are the same ones that send gold higher right now. It's crazy. And that's why, like, if you're a gold lover, or if you're a gold bug, it must be really frustrating to be like, why the hell is gold down today? For the same macro reasons that drove stocks down. There is a correlation of stocks and gold right now. And even, probably, news that, people don't want to hear, Bitcoin is the same thing. Bitcoin is trading just like a risk on, risk off growth stock. It's not a store of value. It's not been an inflation hedge. The correlation with Bitcoin and the stock market is quite strong. So Bitcoin got rocked today because the stock market got rocked. Now, the technical, I don't have my technicals of, do I have them up? I can show you the Elliott wave if you like of crypto. But I do think we're in a sideways consolidation in Bitcoin. Today was nasty, but I don't think this is the start of a significant drop in Bitcoin. We went right to the 200-day moving average, as we talked about. Support's right around the 50,000 mark. And if the Elliott wave interpretation I look at, this is the market model I use to figure out where we are in the trend or correction. If it's accurate, we probably should be finding some support here. And then along with the stock market, I believe they'll both recover, and eventually we'll go and break the 72,000 and we'll move up to 100,000. But right now, Bitcoin and gold are just being influenced by the same macro influences that drive the stock market higher or lower. Right now, they're nothing more than that. And I know a lot of people don't want to believe that, but that's the way the markets are right now. So for you Elliott wave guys who really like this stuff, I think this is probably moving into a wave 4 correction. And eventually, as I said, when the stock market regains, it will move higher out of the long-term resistance. And we hold IBIT. So we definitely took it on the chin today in IBIT, the ETF that tracks Bitcoin. But I like the pullback into support here in Bitcoin right around 50,000. I think it'll hold and eventually it'll break. And I know a couple of people asked for gold and Bitcoin. So, okay. Put a wrap on it, sir. Oh, you're muted.
Yeah, that's a wrap.
Hey, nice job shaving. Look at you. Clean cut, bud.
Oh, shaved for once.
All right.
I've worked for Todd for 2 years. He hasn't seen my face, I don't think, until this week. So.
You're a good-looking guy, man. I didn't know I get brains and good looks. What a package. Hey, I appreciate you listening to me yap.
Well, yeah, no, I think it was good timing on the update, and hopefully we made some sense.
Yeah. Hey, get very thrown together. Just everything came together real quick today. So, yep. Any questions? Please let us know. Reach out, and thanks, man. Thanks, Kyle. I'll catch up with you a little later.
Yeah.